Good afternoon and happy Thursday, everyone. This is Scott Wohlers with River Place Capital. It is Thursday, April the 13th, and want to take just a brief moment to discuss what markets did last week. The S&P 500 was down just slightly, just down 10 basis points or 0.1%. However, the mid-cap and small cap indexes were down quite a bit more, with the mid-cap index down 2.59%, and the S&P 600, which is the measure of the small caps, was down 2.7% on the week. So as we came into this week, we knew it was going to be a very important week as we were getting March's read on CPI, which is the consumer price index, and PPI, which is the producer price index, which PPI precedes and leads essentially the future of what CPI may be doing trend-wise. So we got the consumer price index for the month of March, and it came in less than expectations, which is fantastic news by 0.1%, and it's up 5% year over year on headline. Its inflation is trending in the right direction, and we fast forward to today, and we get PPI this morning at 8:30, and that actually came in down 0.5% month over month, which is fantastic news. And year over year broke 3% at 2.7% as the headline number year over year. So that's great news. However, as we've heard over this week, we've gotten some Fed speak this week saying that they still feel the need, that inflation's not coming down fast enough, and the need in the next meeting is for another 20, is the consensus is for another 25 basis point hike. And the futures are saying there's a 74% probability that the Fed will raise rates in May, getting them to 5%. Now, we at River Place believe that's the place where they're probably going to look to pause, as we're starting to see cracks in the economy and deflationary events that we've spoken about, and that's the banking concerns and things going along with that. But as we've moved into this year, you've seen markets move higher, climbing what we say on Wall Street is a proverbial wall of worry. So there's all of these concerns that may be going on, all of this bad news that we're hearing, all of the pundits, if you turn on CNBC, are telling you how it's all negative and they don't understand the market can't go higher from here, but yet it continues to march higher and climbing a proverbial wall of worry. And there's two reasons for that. One, the market is always a forward-looking vehicle. It is not pricing in the economic data always that it's receiving today. It's taking that and applying what it means 6 to 12 to 18 months from now. It's also a discounting vehicle for what is based off of corporate earnings. And so what we have not seen is a complete destruction of corporate earnings, and that's allowed the S&P to hold this 18 PE handle. Well, that's on the pricey side. For normal times, it's not anything more expensive than we've seen over the last 5 years. So the other thing I wanted to point out is if you have a diversified portfolio going into this year and you were leaning more towards value because that's what was working last year, you may find yourself lagging behind the S&P this year. Well, I wanted to kind of give you some comfort and explain what's going on. The S&P equal weight is only up 2.5% year to date, lagging the S&P 500 by a full 5%, with the S&P 500 up at 7.5% year to date. And what that is you've seen a rotation. The retail investor right now is really sitting on the sidelines in T-bills and money market funds. So you're seeing the market being controlled a lot by quant trading, which is computerized trading. You're seeing hedge funds and more institutional investors driving the market, and that's why you're seeing sometimes such quick reversals even intraday, where what's leading in the morning is lagging in the afternoon as you're seeing profits being pulled. So essentially what you see is a reversal of last year, with growth being the leadership this year and value lagging behind. So you have these institutional investors taking their profits from the value sector that they have for the last year, buying the discounted growth sector, and that's allowed the growth sector to really catapult up this year. And that's why you're seeing that as leadership. So don't be discouraged if you have an equal weight portfolio and you're not quite performing up to the S&P 500. We still have a long year to go. We still believe that equal weight is always the way to go. And the encouraging thing for us is money flows continue to be very positive and very strong. So we're very optimistic on the markets moving forward. So if you have questions about what's going on with your individual portfolio or ways that we can help you navigate this volatility, feel free to give us a call. We'd love to talk to you. You can reach us at 904-346-3460. Or as always, check us out online at www.riverplacecapital.com. Have a great rest of your week, everyone. Thank you so much.